Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to connect the dots and to be that bridge between Wall Street and Main Street. Today, we're going to be spending some time on one of the biggest questions in investing. Do I try to time the market, or do I set it and forget it? Our guest today likes to say there's no time to be passive, so that brings us to our phrase of the day, which is active investing. But how do you even get started? And on today's Market Show and Tell, we are prying open the universe of alternative investments. Most will not have a ticker, so how do you find these assets that can help smooth the kinks during rough patches in the investment cycle? And this episode is brought to you by the number 38. That is the record high age of people in the U.S. buying homes for the first time. What do we make of a housing market that's trapping both buyers and sellers? And today, without further ado, we are welcoming John Grace, who is the founder and president of Investors Advantage, a money management firm he launched in 1979. He is a longtime registered principal with LPL Financial and active on nonprofit boards, being recognized locally on the Valley 200 list. John is the author of Making Finance Make Sense, and we are excited to have you here today. So let's open up with you just telling us how you're making sense of this market right now.
Well, whether it becomes, we're talking about your brain, your body, or your money, we must be agile, all right? Many of us, looking at my wife and my parents, we saw our parents getting into their 90s and want to say, just rest, sit down. Not a good thing to do, okay? Complacency and being static is not healthy.
Humans got to move.
You've got to move, and that means we have to be agile, and we need to have plans in advance so that in the event there's a hurricane or a fire or a flood, whatever it might be, we can get out of that structure safely, and that means our money too. What exit strategies are we putting in place in advance before the bottom falls, before the Titanic goes down with your life savings sitting on it?
All right, well, that's a perfect segue to our phrase of the day, active investing. That's a hands-on approach to trading assets, often with the goal of outperforming a benchmark like the S&P 500. And we should break down the other side, passive investing, which is investing in broad indexes like the S&P 500 through ETFs and mutual funds. That's that set it and forget it style. So, John, it's a classic debate that we talk about a lot of times on this show. Even internally in my own investing life, I struggle between being both an active investor and a passive investor. So what are the pros and cons of each?
Well, I think, Allie, the first question investors are not posed with. The advisors, my peers, we ask you, are you aggressive, moderate, or conservative? I don't understand the question. You don't understand the answer. What the heck are we talking about here? The better question to establish and answer is what kind of loss can you live with? We want a specific number. That gives us something we can see. In other words, we go through a series of questions, and you may come back and say, okay, I think I can change my mind. That's good. I think I can live with a 12% loss in my portfolio. That's all I want to give up, okay? I don't want to be in for another. We went through what, 1, 2, 50% losses in the same decade? And let's understand, this is really important because if you're contributing to your account and there's 50% losses, you're like, hallelujah, this is a blessing. I'm buying more shares where the prices are cheaper. But if you're in your 70s and you have to take withdrawals from traditional retirement accounts, starting at 73 at 3.77%, can you afford another 50% loss? I dare say the answer is, oh, heck no.
Well, and not only that, we just had the worst combination of a bear market in stocks with a bear market in bonds occurring at the same time in over a century. I want to tee you up. You have some interesting things to say about how to be an active investor, and it seems like I don't want to assume anything, so just tell us, and we brought some charts of yours as well.
Okay. Well, yeah, first step is to figure out what kind of loss can you live with. Second step is to take your portfolio and look at it backwards. How did that portfolio perform in Q1 2025? How about 2022? How about 2008? We were sitting with one referral, young lady in her 70s. She's been to over 70 countries. I'm like, I want to follow you, right, wherever you go. Her account, she did not recognize, was off 70% in 2008. Now, the market, as you probably recall, was off 37, and Vanguard was off about 42. 70% in her 70s. That's not a role that's just not something you want to have happen on your watch. So once you see what kind of loss you can live with, now let's see what the portfolio did, and then let's install active management strategies so that in 2008, for example, instead of staying static at 5% cash, 95% invested, that's with the mutual fund funds, and most of the exchange-traded funds do. Our clients saw, as they determined what kind of loss they can live with, in some cases, their account automatically became 100% cash by year-end 2008. What that meant was that the loss was less than 20%, okay? And if you get a 25% net in the next year or so, you're back to even in a year or two, as opposed to taking the passive accounts 4 to 5 years to get back to even.
Now, I have to imagine that some clients might get upset if you have the type of trading environment that we saw over the past 2 years where, 20% gains, unprecedented, back to back, tech leading the way higher.
Yes.
It feels like nothing can stop this momentum right now. So how do you sort of calm investors' appetite for some of that risk?
That's a great question.
While, also embracing the times.
Well, speaking of the times, let's go back to Great Depression 1. This is the president.
1930s?
1929, yep. And 7 months after Hoover took office in March, the economy turned upside down starting in November. Okay, that was very quick. He could not get reelected, all right? And he has a memoir that he wrote in 1952, and I love the way he put this. He says, the Great Depression and the stock devaluation was something reasonable to expect, this is a quote, thanks to the orgy of stock speculation. Now, does that sound like anything going on around right here, right now? The orgy of everything? That's what I'm calling it. Whether it's your house, your gold, your stocks, your crypto, it doesn't matter what you own. You throw a dart in the dark and gosh darn it, it's worth more than you ever imagined it. It makes you feel smart, which means you're not ready. You have no exit strategy. So when things go awry, as they did in the Great Depression, stocks were off 87%. And the securities industry says, hey, you know what? It always comes back. And you go, how long did it take? Oh, just 25 years.
1950s, right?
Yes.
I want to bring this back to a simple concept. You brought some charts along that we can put up on the screen, and this shows the S&P 500 along with cash allocation and also recession risk. And first break that down for us, but then also answer, how does one get back into the market? Because after somebody has left the market and things are falling apart, it's very difficult to get back in.
You're 100% right. And if you get one side of the trade right and the other
matter.
side wrong, you're at 50%. That's an F on anybody's test. Okay, so we like to use active management strategies. Okay, these are the companies that will do this work. They're looking at our clients' accounts on a daily basis, asking and answering the question, is it risk on or risk off? So what we can see is when the recession risk is monitored by some firms and not by all, when that's rising and the stock market's falling, our clients love seeing automatically we moved from shares out of risk assets to cash as the market is coming apart at the seams. So that's how these folks ended up only being down less than 20% in 2008 as the market is going down like the Titanic. That's what we think is the answer. So we've got to be agile, and folks have to look at the investors' accounts. Is it risk on, like Karate Kid? Is it risk off? In a bad year, we want to risk off. We don't want to try to do this manually. In fact, look at first quarter 2025. Some of our clients saw some of the shares in U.S. stocks declining, moving money out of U.S. stocks to internationals.
Right.
That helped offset the decline in the U.S. market in 2025. And by the way, we would not be surprised to see this distance continue, internationals outproducing. Been a very good year so far with the U.S. stock market, but we all know that all trees do not grow to the sky.
This is really fascinating. I want to shift gears for a second because it's time for Market Show and Tell. And today we are breaking down alternative investments. As you might guess from the name, these are not the stocks, bonds, and crypto tickers that you're used to seeing on this program. They are plays in real estate, private credit, hedge funds, structured income funds, commodities. What's all that? They're used to diversify and smooth returns, but they are also not usually as liquid as stocks, meaning that they're harder to buy and sell. They're also harder by nature to find, harder to understand, harder to assess in quality. So people often rely on advisors for this, and they pay money to do that. So tell us about some of these alternative investments and what you're seeing in this space.
Well, let's look at the smart money, like Yale Endowment as an example, all right? They've been at it a while, and Yale says in their site that they didn't lose money in 2008. Now, how could that be? What they say—
They didn't mark to market.
Well, what they say is we're not doing the 60-40, the classic portfolio mix that your mother, your grandmother, you're supposed to have. That's what the industry has said. Like, nothing has changed. They said, no, we don't do it like that. The last time I looked, by the way, their exposure to U.S., well, let me ask you, What do you think Yale has, the last time I looked, in U.S. stocks as a percentage? It's about $40 billion or so.
I'll just say 30.
30.
Yeah, I was going to say 30. That
How-
seems like a middle of the road.
Seems like a good number. That was my answer. The correct answer is 3.
Ah,
Are you
wow.
kidding me?
order of
Right?
magnitude.
Okay. So, and then people say, well, it must all be in bonds. No, I count 7 different asset classes. All right. And I just happened to look just this week, and I can see that Yale submits that their returns over the last 10 years have been about 9.5%. They're looking for consistency. They don't like being on the roller coaster. Okay. So they want to limit the losses. That's their goal. And they do the work necessary so that they can not have to stay on that roller coaster. I count 5 to 6 different asset classes. By the way, none of them are larger than 24%. Now, does that sound like anybody you know where it's 80, 90% in this, that, or the other, real estate or stocks, okay? At least 70% is, even for boomers, is pretty ordinary. So notice that they're not making any big bets, and their exposure to the traditional assets is a lot less. And the institutions and endowments and the foundations have been in alternatives for the last 40 years. They're used to these positions. They're just becoming available to retail investors.
And what do you think of crypto, which to me is very much an alternative asset that's in vogue right now? But you talk about the roller coaster ride.
I would say be not surprised to watch crypto, and it may be the first position to start reaching new lows, okay? And by the way, if you ask me, nobody can forecast the future, but if you ask me when this might happen, we do have a forecast for stocks and bonds, but we think the decline will be led by crypto. So don't keep getting high on the hopium, expecting that this is just going to keep growing. You know, things do come apart at the seams.
All right, we need to take a short break, but coming up, we're talking about Gen Z and millennials increasingly priced out of buying new homes, plus a runway showdown between Warren Buffett and your favorite Mag 7 hyperscalers. Stay tuned. Well, this episode is brought to you by the number 38. That's the average age of first-time homebuyers in the U.S., according to the National Association of Realtors, the oldest on record. And here's the flip side. First-time buyers now make up just 24% of all home purchases, the lowest share since the NAR began tracking this data. So bottom line, it's getting tougher and tougher for younger Americans to break into the housing market. And John, this is something that my generation has been dealing with. It's very frustrating. So explain the dynamic that's happening right now.
Okay. Here's you and I, all of us consume the most potato chips in our life at 14. And as parents, we bought the most potato chips in life at 41
like
for
where
our
this is
average
going.
14-year-olds. Okay, so there's some patterns that most of us don't pay attention to. When it comes to real estate, the pattern has been boomers bought their first house at 31. Millennials are at 38 or so right now. And then they bought their biggest house at 41. We'll talk about what comes next. It's not shortages, by the way. But let's just look at when boomers were standing in line. I was one of them. The rates were 16% for 30 years. Are you kidding me?
1980s?
That's right.
Yes.
And when we got together for the holidays, Halloween, Christmas, right, whatever,
Oh, I
Thanksgiving
got
show,
a 13%.
everybody was, oh, you got, how'd you get
is
that?
crazy because now with like
Right.
6 or 7%,
Well,
can you believe it?
Who told boomers there would be 3% money?
Yeah.
They would have kicked you in your face, right? There's no way that's going to happen. So let's just see. We look at what we're missing is the NAR says you got to look at interest rates, location, and inventory. I'm sorry, those are 3 different balls that you're trying to keep in the air and then synthesize what all this data means. No, just look at the buying and selling behavior of consumers based on age. That's what's so different. So 31 first house, 41 biggest house. That's when boomers had to have the McMansion, couldn't live without it. And what's next? What are we hearing now? Oh, it's all about shortages. Well, no, it's not. From the same source, we can see, wait for it, there are 16 million vacant homes in America. Are you kidding me? And guess what? The first 2 states that lead the list happen to be Florida at 1.7 million and California at 1.2 million vacant homes. Really? So 78 and 79 are a terrific 1-2 punch that we have never seen before. So that's why we have to be cautious about looking backwards as history, as though that's going to pretend the future. Okay? 78, 79 happened to, it's a twilight zone. 78 happens to be the age that most people sell their homes, and 78, 79 is the age that the average age of people going to heaven. So now you tell me, would you rather buy now and wake up and find that prices revert back to where the bubble in real estate might have started. That would be 2012. So look at any address you are looking at and go back. You can only go for Zillow 10 years, but get close there. And you may find on the coast, right, the decline could be 60%. So if that doesn't bother you, go with God. If that bothers you, I would say keep your powder dry and wait for this elephant to kneel, because in the Midwest, we see prices becoming maybe 50%, on the coast 60%. So this would be a time, I would say, to the folks who want to really play the game, be patient, keep your powder dry, see what happens to these prices. Don't do the fear of losing out. You don't want to do that when, just wait for prices to come down and then get on the elephant at that point in time.
So when does this elephant kneel? Because I know a lot of people out there might be thinking, okay, this is good news potentially, but how long do I have to wait? And what are the triggers? What are you looking at?
Yeah. Well, look, there's no way in the world anybody can answer that question intelligently. When's the next flood going to happen? When's the next earthquake going to happen? Okay. No one knows the answer to that, but we might want to look at some of the data that we're not studying. For example, homeowners are delighted that home prices after COVID in the Midwest have tripled approximately, and the coasts have quadrupled. Yay for homeowners. Here's what we don't recognize. What happened to the average household income? Why, it only went up 1.6 times. Does this sound like it's sustainable to you, or does this sound like there's going to be a disconnect happening anytime soon? I think it's underway now. By the way, the last time we made mention in 06 and 07, thanks to the research team, that we thought prices in stocks and real estate would upend themselves. Stocks were off over 50%. Real estate was off 35%. This next time we think it'll be worse and more severe and take longer to recover. Let's just look at it this way. We've got 20% of the population, those are boomers, who own over 40% of the homes. That's a big segment, if you will. We're all going to go to heaven. I'm going to be an optimist, okay? So you tell me where you think prices are headed.
So that seems like a flood of supply.
100%. At some point, we've got to get back to supply and demand. So when 20% of the population go to heaven and the inventory remains like a dead woman, dead man's EKG, where do you think prices are going? Do you think they're going to continue going up? Do you want to take that bet? I'm going to submit to you this. The people are going to heaven, and the home prices are going to a very hot place.
Okay. All right. Well, you just talked a little bit about how there still are vacant homes out there.
Yes.
So what's the supply versus demand dynamic now? Because prices are, hovering at record highs in some locations.
Well, let's just recognize the last time we saw that 35-40% decline in home prices from peak to trough, it took 6 years. So it didn't happen overnight. So that's why I'm saying you have to be careful of making your bets. That's why I say worst case scenario, if you get in there and you get the curtains just fine and the window dressings all handled, it's beautiful, and then the price drops 50%, would that be okay with you? And for folks who have multiple houses, do you really need all those? Let's just look at, you talked about Warren Buffett. Is he sitting on $344 billion at 95? I suspect he's ready to take advantage of distressed sellers. Do you want to be one, or do you want to be poised for success by having the cash to watch the prices come your way, and then you can take a ride on the Reading Railroad?
John, that is the perfect segue for our Runway Showdown today, because we now have a classic take on a Hollywood gab show staple. Who wore it better? Today's runway is a tale of two giants. It's the classic war chest versus the big tech buildout. So let me explain. On the left, we have Berkshire Hathaway's cash hoard, around $344 billion that Warren Buffett has been amassing as a rainy day fund, ready to pounce when prices become wonderful, as the Oracle likes to say. On the right catwalk, we have big tech's AI buildout, about $364 billion in capital spending this year, roughly $1 billion a day, pouring into data centers, power and gear. This isn't just accounting, it's two ways to potentially win. One side waits for great deals, the other builds for the future and hopes to gain market share in an emerging technology, just as demand is surging higher. And each has its pitfalls. Investors have questioned whether Warren Buffett still has it at age 90-something, or if he's gone soft, waiting for the perfect mega deal. And history does not actually favor the big spenders on tech. Their sky-high multiples tend to come back to earth, even if they do eventually capture the market share for a new technology. So John, Which look bears the current market better in your portfolio, the big war chest or the big tech build-out? Patience or pace?
Well, stay tuned. Film at 11, right? But let's remember who loaned what company. What was it, $5 billion?
Goldman?
Oh, that's right. And the yield was what, 10% plus the stock value? Was that a good bet? I think that was a spectacular bet, and he's ready to do it again. But I like that you brought up the data center infrastructure because we like some positions that are just consistent. They're not exciting. They're not going to get on the roller coaster. We want to be bored with consistency. Yield 3, 4, 5%, the return 10% net to the investor. So a couple of the positions that we had available, new alternatives to investors, was taking a position in owning the controlling interest of privately held companies. All right. We said back in 2018, we thought that would be recession resistant. Nobody was using that word.
This is alternative investments you're
Yes, it is. Yes, and some are liquid and some are illiquid, okay? But that's exactly what it's been doing, okay? It's owning like 18 different companies. To get a sense of it, it's like owning shares of or owning a position in Dunkin' Donut or Nothing Bundt Cakes as a couple of examples. The other one we really like, this is a company that has 2007, 67% of the portfolio was commercial. They had their eyes and ears to the ground. That's now down to 2%. Where have they gone? Many of us get static. They did not. They're only 2% commercial. They're now in infrastructure, manufacturing, the largest owner of student housing in the country. That's strong cash flow. And the largest owner of data center infrastructure in the world. Okay. Again, about 3-4% as a yield, 10% net to the investors since 2018. Held up well 2022, no declines. First quarter 25, same story. We think this will continue to hold and do well. And by the way, the data center infrastructure just in the last year has gone from 8% of the portfolio to 17% of the portfolio. And just look at data center infrastructure. Who knows what AI is going to do? Does it make you upchuck, or do you say this is the best thing since sliced bread? But if you own the structures that has all of this technology, and I'm not even sure they have a bathroom, something's got to hold the 30,000 square foot buildings. So it's much akin to being like Levi Strauss back in the gold rush days. He wasn't panning gold. He wasn't selling pots and pans. He was selling jeans that you had to have to survive in that cold.
The original picks and shovel trade. I love that. And guess what? We are out of time here on Stocks in Translation. Brief recap. I love how we just tore apart active investing today. I learned a few things because you can almost be passive as someone else kind of actively invest for you. It's just not necessarily buying and holding that index forever. And then talking about alternative investments, I think we dug into that quite a bit. Not for everybody, and you got to pick your advisor well, but something definitely to look for in uncorrelated returns. And also the housing market. I am just glad I am not looking for a house or in the market right now. On that note, we have wound things down here at Stocks in Translation, but be sure to check out all the other episodes of our video podcast on the Yahoo Finance site and mobile app.